Hi everyone, William here. Today I'm going to be talking about a story that has legal and financial elements, and I need to start by making it clear that I am in no way providing legal or financial advice. Even if I were qualified to do so, which I am clearly not, this is an opinion piece only. Thank you. The question for today is, Wall Street bets versus hedge funds. Is this market manipulation? My answer has got to be yes. But I am not really convinced that this is a bad thing in this particular case, and I'm not too sure that the SEC, the Securities and Exchange Commission, will see it that way either. Some background first. For the last week or so, one story has set social media ablaze. It has dominated the news cycle and sent the financial world reeling. A subreddit called WallStreetBets has taken on large hedge fund companies and possibly won. This is an event that has taken on a crowd-pleasing narrative, a classic David versus Goliath story, where the everyman has beat the amoral rich investment group at their own nasty game. It has even united enemies in the celebration of sticking it to the man. Right and left-wing political figures find themselves on the same side. Not entirely, of course. I'm guessing there's a correlation with how rich a person is and how likely they are to back the hedge funds in this one. But the support is overwhelmingly on the side of the Redditors. So who are the players involved here? WallStreetBets is a financial subreddit whose members are relatively new to investing and generally young in age. It has been described as a meme-ridden hive of weirdos. I am paraphrasing, of course, but that's the gist. Although there are other companies involved, the main focus on the hedge fund side is a company called Melvin Capital. And this is because they took a particularly large short position on GameStop stock that the Redditors took advantage of. The quick definitions here. Taking a short position on a stock is betting on the price to go down, instead of what you might think of as the traditional long position, which is betting that the stock price will go up. Now, GameStop is a brick and mortar video game store that many people have identified as a company that would obviously need to make some drastic changes in order to remain relevant in a time where most people are obtaining their software via digital download, with the trend clearly going to a point where physical copies will be a relic of the past. Another player here in the story is Robinhood. This is an app that allows you to trade with no transaction fees. All the other trading companies were involved here as well, but Robinhood received special attention here because the app is very popular among this particular group of traders. And therefore, a lot of the money was going through Robinhood, amounts that they were not equipped to cover. So what happened here? Members of this subreddit noticed that a very large amount of short positions were taken on GameStop stock, to the point that more stock were shorted than actually existed. Now, this is something that can easily happen when shorting a stock because of the nature of the contracts involved here. Remember, I said that shorting a stock means that you're betting that the price will go down. This works because you are literally borrowing the stock and selling it to someone else at the current price. Then, hypothetically, when the price goes down, you buy some stock and you give it back to the person you borrowed it from. Now, because the stock that you borrowed and sold could then be borrowed and sold subsequently without the borrowers actually buying anything, you can see how easily you could get to a point that the outstanding shares to be bought would outnumber the amount that actually exists. Another key point about shorts is that unlike your traditional long position, where the maximum you can lose is the entire value of the stock, meaning the value of the stock you hold is $0, there is no maximum amount that you can lose on a shorted stock because there is no maximum on the price point when you have to go buy it. So it is inherently a risky bet to make. Now, about short positions for a second here. There is a lot to be said about whether or not this should be even legal or is in any way moral. I am not going to address that at the moment, but I do want to speak to the first point that people often bring up when they learn about shorting stock, and that is, how am I able to sell something that I don't even own? Well, that's a good question. But the answer is simply that there is a full contract here that takes the whole maneuver into consideration. It's really a contract to borrow at a particular interest rate, and yes, you are paying interest on this deal. then to buy the stock in a particular time frame. It's all together. Now, the law says you have to make sure that there are going to be existing stocks when everyone goes to buy them at the other end of the short positions. Allowing the amount borrowed to exceed the amount existing is known as naked shorting. And although there appears to be more shorts than stocks in this case, there were complaints filed to the SEC earlier this month, in fact. It's not entirely clear who is responsible, or even if this is technically naked shorting. So this play that the Redditors made is known as a short squeeze. They took advantage of the public knowledge that the hedge funds were taking this risky position and used their collective buying power to move the price up. Now, when this happens, the person taking the short position has to buy quickly in order to stop the bleeding, so to speak, because, as I said, there's no upper limit to your losses. And this action further exacerbates the problem by driving the price up even more in this crazy volatile feedback loop. Now, I just want to throw in the point that although the media, including social media, is focusing on the narrative that this short squeeze was performed as a way to get back at the large investment companies and Wall Street in general, that doesn't mean there were not other reasons to buy this stock. It's possible that this was not just a risky bet, but a poor bet on the part of the hedge fund companies. There really were reasons to invest in GameStop. They had recently attracted a huge investor, the founder of Chewy, they sell pet food online, who appears to know what he's doing in the area of e-commerce, which is clearly the direction in which GameStop would need to go in order to survive into the future. They had also signed a potentially lucrative contract with Microsoft. I just want to add that to the mix. Later in the week, outrage was provoked when the trading companies, like the aforementioned Robinhood, halted trading, then only allowed users to sell their stock. This certainly had the appearance of collusion with the large investment companies to allow the stock price to lower to a price that would not leave them bankrupted. There are also the beginnings of class action lawsuits from the app users for lost profits. Are there legitimate reasons to halt trading? Yes, it happens frequently when a stock becomes so volatile that the price is not real, so to speak. It's also done when fraud is suspected. It's done ostensibly to reduce the broker's liability from future lawsuits. Is that what happened here? Or is this just a case of favoritism to the traditionally rich? I'm going to let you decide. There are also calls already for government bailouts, in addition to bailouts from other corporations that have already occurred. This is not going over well, as it is generally seen as adding insult to injury. The merits of corporate bailouts are a good topic for another day. So who's wrong here? Who's right? There are terms of service between Robinhood and the app users that may help to cover both parties in this mess. Not really sure how this is going to shake out. You can never really know how much of that wording becomes usable until it is tested in court. Now, didn't the hedge fund companies make the real mistake by overshorting in the first place? Yes, of course, but that doesn't mean that taking advantage of the situation leaves you in the clear. So let's get back to the original question. Is this market manipulation? Now, this is important because that is a phrase that the SEC uses to describe a specific legal action. They are often searching for fraud and/or market manipulation. What the Redditors did is clearly market manipulation by the normal definition of those words. What is not clear is whether or not the law would agree. At first glance, it's hard not to notice that there is obvious collusion here to run up a stock price. Sure sounds illegal, but the fact is the SEC has not always seen this type of collusion as a problem in the past. But of course, the examples we have are of hedge fund managers getting together, not the common people. You would hope there would not be a double standard, but that remains to be seen. Okay, so I pointed out that this is a short squeeze on the part of the Redditors. Is a short squeeze illegal? Well, the SEC has gone after people in the past for doing this, but it's not clear that this particular case would qualify because their thresholds and the entire scope of their definitions are not really public knowledge. You would think it would be clear, but there's so much that is untested. Another phrase that you will come across in this context is the pump and dump. This is a strategy that some large shady traders will make where they invest in a stock. They hype that stock to drive up the price via misinformation, and then they sell it. Pump and dump. Now, that strategy should clearly be an example of the type of market manipulation that the SEC would see as illegal, and it is. But the problem is that it's only clear because a major aspect of this crime is the hyping of the stock via misinformation, because that is fraud, which is already illegal. In our GameStop case, there's no obvious lying going on here. In fact, the group has been very transparent as far as we can see. So this wouldn't seem to qualify. But I need to point out that even if this wasn't a pump and dump situation, it would obviously provide cover for anyone to do this in the future. And WallStreetBets is in fact aware that they are always in danger of market manipulation by nature of their board, which is why they have certain rules in place to minimize it, such as not hyping lower volume stocks. And I keep seeing the argument that regardless of the Redditors' actions, it's okay because the hedge fund companies carry out market manipulation all the time. This is fair enough if you're looking at it as a high-level moral question, but obviously that is not a valid legal or logical argument. And again, this is a dangerous path because the moral argument could clearly be used as a cover in the future. And this touches on another point about the legal aspect that I think is important. I see people arguing that it has nothing to do with intent on the part of the Redditors, meaning it's the actions that matter, not whether or not they had a specific intent in their mind when they did it. This seems completely reasonable and a logical way to move your way through the issue. But it's simply incorrect when it comes to the legal aspect. Intent is often a factor. I know you can think of many examples where intent, even if it's not easy or possible to discern, is a major factor in the type of charge that a person could face. And this could quite possibly be a factor here if it went that far. So at this point, and there are new factors uncovered every day it seems, I have no idea if what the Redditors did was illegal. And it appears that no one else has a solid grasp of this either. But the consensus seems to be that it would be hard to prosecute, but possible. Was this market manipulation? Clearly. But in a fair way? I think the jury's still out. I know there's more information to come, and we will be talking about this one for a while. Thanks for listening. Please like, subscribe, and I want to hear what you think. Be kind, be safe, and I'll see you later.